you are.
So thank you, ma'am, and thank you, Tolani Institute of Management, and thank you all the attendees who are attending. How many people are attending at this point of time, ma'am? Ma'am, you are muted. I can't hear.
Sir, we have 25 participants as of now, and we may have a couple of more of them joining in some time. Basically, it is a finance specialization, sir. So they are in total 29 in number, right?
Sure.
So out of that, we have 25 right now with us.
Sure.
Okay.
So let's get started. And before we start, I just wanted to let you all know that in the presentation, I'll be covering a lot of topics, and the presentation will be shared with all of you. So focus more on what I say and try to ask questions. So maybe after every 10 minutes, I'll give a 2-minute pause so that if you have any queries, we can take that up. Okay. And about 1 hour for the first session, ma'am. So
yes, sir.
So so we have 2 sessions. We'll have the first session for an hour, and then we'll take a break, and then we'll move on to the other session. So, ma'am, can you share the presentation so that we can start?
Okay, sir, I'll do that. Visible, sir?
Yeah, yeah. So let's move to the second slide. So basically, I'll try to give you a flavor of economic moats. We'll understand about moats as we go ahead. So the whole purpose is understanding business, industry, and competition from the lens of economic moats. Next. So this is the agenda. I'll speak briefly about industry life cycle. What is competitive advantage? What is moats? Different types of moats, mistaken moats and eroding moats, how to measure moats, assessing management, how to spot red flags in management. With management, I mean the management of companies or businesses which we study for investment in stock market. And then in the end, conclusion. So this first presentation is to give you a flavor of how we do our analysis. And in the next presentation, we will take up a case study of a listed company. Yes, ma'am. Next. So industry life cycle is generally, I'm sure that you must have already read about this, the pioneering stage, rapid growth stage, maturity and stabilization stage, decline stage. So whenever you are studying any industry, it is very important to see what kind of stage it is in. So if you ask me very clearly, some of the oil companies like ONGC and HPCL and BPCL, they are not in pioneering or rapid growth stage. They are in maturity and stabilization stage, and who knows, maybe they will be entering the decline stage soon. Why? Because we know the way electrification of the world is happening with the advent of electric cars and all. We are sure that we don't know the timeline, but we are sure that that is where the world is moving. Similarly, if you look at IT and IT related services or businesses, there are many companies, many businesses which are closely related to this new technology, new digitalization. They are still in, some of them are still in the pioneer stage where you will see some product companies being developed, and then some are in rapid growth stage. So any IT company which is basically a service provider or product development person, they are providing any service in the new cutting edge technology, they are into the rapid growth stage. So that gives you a, so whenever you understand or whenever you are trying to study an industry, try to think from these stages point of view, how much growth you can expect. Nobody can pinpoint the growth rate, but there should be some sort of a direction wherein we should be able to know how the companies, what kind of growth potential this industry has. Next slide, ma'am. the slide prior to this one. Yeah. So basically, this structure and characteristic of an industry, the industries are characterized based on their nature of competition, prospects of demand, cost efficiency and profitability, and technology and research. Let's forget what is written on the slide. Just take an example. There are several industries which are highly competitive. Competitive means where too many players are chasing the same sort of business. So a very good example would be something in the infrastructure space. You'll see there are umpteen number of construction companies all over the country, be it southern, be it northern or any part of the country. You will find so many players doing same sort of work. So that gives you an understanding that this is an industry where it is very difficult to have a branding power or an edge, because you don't have anything special to do. All the players are basically doing the same work, and there is too much of a competition. So for an industry like that, a player can only create an edge through something like, say, good completion of projects, so early completion of projects, or completing the project in time, saving costs. So there are very few levers for those companies to work on. Compare that with FMCG companies, where they have so much demand that even though there are 5, 7, 10 players in that industry, they don't have to sacrifice on their margins. They can maintain their margin and also still achieve a very good return on capital. So that gives you a flavor of how you can try to understand an industry from the nature of competition, demand, cost efficiency, and profitability. Next slide, ma'am. So Porter's 5 force analysis, you must have already learned about it and read about it so many times in your classes itself. So I'll just quickly go through it. So any industry or any company will be competitive based on these 5 parameters. How easy or difficult it is for a new entrant to make a mark in that industry. How much the suppliers can have the bargaining power when they interact with you. What are the threats of substitution if you are in an industry where substitution risk is very high. Similarly, like in case of auto companies, just to give you an example, many auto companies in India, 2-wheelers, 4-wheelers, whatever you take, they are not very much inclined towards the EV space yet. So that is a threat for them. If the EV comes in full flow, be it in 4-wheelers or 2-wheelers, if the company which is right now only focusing on diesel combustible engines, they will find it very difficult to survive or make a mark when that EV thing will come up. And history is an indicator that these things come faster than what we anticipate. Like nobody could time the COVID thing, but you can see how many of us are interacting through a live online platform, Zoom. So Zoom is not listed in India, but you can check the stock price of Zoom and see how it has skyrocketed just post-COVID. And nobody could have this kind of a foresight, say 1 year back, that this would be the growth rate of Zoom, right? So similarly, we can have the competitive intensity, the buying, the buyer's power, and the competitive rivalry. Next slide. So how to strive in a competitive industry? So you can in case of a competitive industry, what you can see is you have to have some sort of a differentiation, some sort of an area or edge where apart from you, nobody can do that thing as good as you. When I'm saying you, I mean one company or one business. So industry, the stock market or the economy is filled with examples where even though a company is been into an industry which is not very conducive to have a competitive advantage, but still by having a brilliant strategy, some business houses, some promoters do end up making a mark. So a very good example which comes to my mind over here right now is DMart. So if you read up history on retail businesses, and if you can see the performance of retail businesses in India over the last 15-20 years, you will see that DMart is an exception. Prior to DMart, whichever companies came into the market with that kind of a model, with this model, they never survived, or they were, even if they survived, they had huge losses. They couldn't cope up with the market. But in case of DMart, what you can see is they had a distinctive strategy. They had a differentiation. They also had cost advantages. So if you'll say, I'll just compare DMart with say other houses like Big Bazaar and all. The biggest cost advantage DMart has is all their DMart stores are owned by the promoters. So the cost of rent is already gone from the books of the business. So in case of all other franchise, all other brands, you will see a huge, if you check their balance sheet, you will see a very significant amount of expense, which is rent of their the outlets. That is where DMart makes a huge mark, where their promoters came up with an idea that we will not pay rent. We will buy the house, we will buy the real estate in our personal books and slowly build this model, and we don't have to worry about rent, and that will make our balance sheet leaner. Similarly, they made subtle changes in their inventory plan which help them have a better asset turnover ratio compared to any other competitor. Because if you notice, just go to any DMart store and just try to notice how people are buying stuff, and how if you just go to one DMart store, say for 10 days regularly, you will see so quickly their inventory keeps on getting replaced. So that is the most important part in case of a retail business, and that is where they are always working on compared to all their competitors. So next slide, ma'am. So before we go into the economic moat and competitive advantage, I can wait for a couple of minutes, and if you have any question, you can take that up.
Yeah, anyone of you, if you have any query, you can ask in between. Okay, so if no one has a query, we will continue with the presentation. Meanwhile, all those who are still not on with the video, right? Akansha, Nishi, Vaishali, Amir, Surbhi, Ekta, please keep your videos on.
So shall
sir, you may please continue, yes, sir.
Okay. So what is an economic moat? Moat is basically, if forget about economic moat, first try to understand what is moat. Moat in a very simple language is the origin of moat is long back when there were kings and castles. In those castles, if you can see the picture over here, there is a white, there is a blue colored body, water body over there. So earlier the castles used to be protected by this water body so that the attackers cannot come in, and that was a very potent way of protecting everyone in the castle, because castle was very it was something which had not only so many members but also a lot of wealth generated over generations. They couldn't afford to let go of those possessions, right? So if you take that analogy, businesses and industries also has these kind of moat or castle built out of, wherein some businesses they make this kind of a water body around themselves, so that the competitors over here, there will be no attackers, there will be competitors. The competitors will not be able to challenge their business or hurt them, right? And how can you do that? There are 5 ways of doing that. The biggest or the most important one is brand or intangible assets. So if you can have a brand or a patent or a trademark against your business, say for example, uh, take example of the brands of HUL, right? So HUL has so many brands in so many businesses and industries, and their sales, their products get sold only because it has an HUL mark. When you see the HUL mark, you know that you don't have to worry about the quality. And that is how they keep on producing new products and keep on selling new products. And we buy them even without noticing that how much they are earning or profiting out of our purchase. The second one is regulation mode. Regulation mode means there are some industry where it is very difficult to get a regulation or license based on many preset criteria. It takes a lot of time, lot of effort, and lot of skills to get those kind of regulation in place to start a business. A very good example would be banking. It is not an easy job to get a bank license. So there are many NBFCs in India. There are hundreds of NBFCs in India. NBFC, I hope you understand NBFC, non-banking financial companies. But they are not so many banks. Banks are less than 100 in India. If you count the total number of banks, in fact it is somewhere around 50 to 60. So why the banks are less and NBFCs are more? The main reason being, it is easy to get an NBFC license, but it is very, very, very difficult to have a bank license. So if you are a bank, you are naturally having a competitive advantage or an economic moat to do your business better than other players, right? Then there are cost advantage. If you can build your business based on very low cost, and that low cost comes through working at large scale. So I gave an example of DMart. The biggest advantage of DMart is they have really large stores where they can, at one place, they can have so many different products, different items at display, and that is where their cost per unit and cost of carrying inventory goes down. Then the other one is switching cost, high switching cost. So what is high switching cost? Say you are having a bank account in HDFC Bank, and I'm sure many of us would be having our bank account in HDFC or ICICI or Axis. Just for the sake of understanding, I'm taking the example of HDFC. If you are having a account in HDFC and many of your family members are also having account in HDFC, do you think you will change to another bank just because you had some problem online, or one of the bank's representative didn't behave properly with you? That is not going to happen, because you don't want to go into that hassle of closing the account, transferring the money, or if you are already having a demat account or FD or some other, say, stuff like jewelry and all, you don't want to go through those hassle of closing this and then transferring it to that. So it makes switching over here is a little difficult for you. You don't want to go through that pain. So whenever your business is based on such characteristic where the customer is facing a lot of problem switching to another competitor, that itself gives you an edge over other businesses, right? And the next one is network effect. So network effect, I'm sure you guys would be knowing about it at all already, because as I give the example of Zoom. So as more and more people are now on Zoom, the value of Zoom is getting increasing and increasing. Why? Because more people means more business will be done, and more business means more institutes or more business houses will be downloading the premium version of Zoom, so that they can conduct these kind of online webinar or any kind of meeting, right? So you can take the example of Facebook, Twitter, they all have this kind of network effect. So generally any business which benefits from the more number of users getting more value for them, those are the business which are getting the advantage of network effect. And the last one is digital moats. So digital moats, again, I've already given you the example of Zoom over here. Digital moats is again those where at one place you can cater to 5,000, 10,000 or even million people at one go. So that is how different types of competitive advantage or economic moat can be developed in your business. So ma'am, we can go to the next slide. So if you can see, a jar of honey will always attract a lot of bees. So when we see or when we speak about high competitive advantage business means higher return of or more margin or higher return on capital or return on equity, we forget one important point. If any industry which is giving good margin, that industry will automatically attract a lot of competitors. So any industry where there was, even I'm sure many of you would be having your own business also. If you can speak to your dad or your elder brother or sister, you will be getting to know that 10 साल पहले कितना margin था और आज कितना margin है. So the margin has basically shrunk. Why? Because the more competitors have entered the business. So if anyone asks me what is the single most important part of understanding whether a industry is having any competitive advantage or not, I would say barriers to entry. If your business has a good barrier to entry wherein new businesses like new honeybees cannot chase you in the market, then you already have a big edge. Ma'am, we can go to the next slide. So why competitive advantage is necessary? Unless there is a competitive advantage, returns on capital will be mean reverting. I hope you understand the concept of return on capital or return on equity, right? So if you analyze any steel or commodity industry or any kind of industry which goes through a cyclical phase, just go and look at their returns or look at their margins over a long period of say 10 to 15 years. You will find some businesses having huge margin or high margin at a particular time, and then again the margins go down for a few years, and then they again go back to the high margins level. That means they keep on reverting to the mean. It is a cyclical industry. But if you check some of the FMCG companies like Nestle, HUL, Dabur, you will see their returns on capital continue to be really high, upwards of 20%. Why? Because they don't go through this cycle of high growth of an up cycle or a down cycle. Because just try to look at what kind of products they sell. Recession ho, boom ho, jo bhi ho, we can't live without having live without soap, because we need soap for taking a bath. We can't live without food because we need food for our daily life. So when you are investing in those kind of businesses, you are always having that secular demand in a country like India, and you will see those companies which are basically producing those kind of products. They always have a better or a consistent return on capital over a long period of time. That doesn't mean that I'm saying you to just buy them, because valuation is also something which we need to look at before buying a company. But just over here, we are trying to understand which kind of businesses are really attractive and which kind of businesses are not attractive. So any kind of cyclical company or commodity company where you don't have any competitive advantage, it is very difficult to make money out of it over a long period of time. There are very few companies which are able to withstand the relentless onslaught of competition for long periods of time. And those are the companies which can be called as wealth compounding machines. And our job should be to identify such companies. And we do not need too many. A few would serve us really well, because if you just buy a couple of good companies and hold them for a long time, say for about a 10 years or 15-year period, you will make humongous amount of wealth that even if the other stocks don't do well, it doesn't matter to your portfolio, right? So next slide, please. So types of economic moats we have briefly discovered already. You can have a pictorial view over here. So intangible assets, customer switching costs, network economics, and how they can affect the performance of the company. Next slide, ma'am. So what are intangible assets? We have already discussed this one also. Brands, patents, regulatory license. So brands, you know about the brands. In case of brands, we must understand, just because it is a good brand, just because everybody is using that brand, doesn't make it an attractive investment opportunity. An attractive investment opportunity will be that business which is able to sell those brands repeatedly on a very good profit over the years. If you are not making profit on your brands, then those brands are not worth making an investment into as an investor, right? So you might be, it is very important for us to know which cap to wear. Sometimes we'll wear the hat of a customer, and when we are wearing the hat of an investor, we should understand we should not mix both the things, because say for example, you might not like the way bank representatives solve your problems in a bank. So you might not be a very satisfied customer of that bank, but because of the unit economics of bank and because of its whole scale and the performance over the last 2 decades, you would still want to be an investor in that bank because of the attractiveness of the business. Similarly, there could be a very good retail product made out of a company which you really like as a customer. But when you look into the balance sheet, when you dig into the numbers, financial numbers, you find out that they are not making profits, and it shows on the lower return on equity. That means you should avoid that business as an investor. Even though you love the products and you would want to be a loyal customer, you should not be an investor in that company. So I hope you understood the concept of understanding when you would want to be a customer and when you would want to be an investor in that company. Next slide, please. The brand, we have spoken about moats, and whatever we have discussed right now has been some formulas or some methods where we can identify different types of competitive advantage. But the biggest and the most hardest competitive advantage which can be built in is being an intelligent fanatic. Try to understand. I'll just read out this quote because this is very important. You do get an occasional opportunity to get into a wonderful business that's being run by an intelligent fanatic. And if you don't load up when you get these opportunities, it's a big mistake. Do you guys know who is in the picture over here? Anybody from the class? Can anyone answer? Who is in the picture over here? Since you are all finance students, can anyone answer? Ma'am, are they all muted from your side or?
Sir, they can unmute themselves.
Okay. So I guess nobody knows, right? So let me give you a brief background of this person. I would say probably I've learned most of my investing knowledge just by reading his transcripts of wonderful talks he has given over his long life. He's currently more than 95 years old and still working. And he has been in the investment world for over 40 years now. And his name is Charlie Munger. Probably you would not have heard about him, but if I'll tell Warren Buffett, you would have heard about Warren Buffett, right?
Yes, sir.
Warren Buffett calls him the smartest person on earth. So that is the kind of intelligence this guy has. And this is what he has to say. And just for your knowledge, he is the partner of Warren Buffett in his company. So even though everyone knows about Warren Buffett, not many people still know about Charlie Munger. And actually Warren Buffett learned a lot about investing only by following Charlie Munger's advice. So I would really recommend you all to just read as much as possible about what Charlie Munger says about investments. Google and YouTube is a very good source. Just type in and try to get into as many. The best ones are his long lectures. So I would really recommend that. So coming back to the topic of intelligent fanatics. So what he says that just being intelligent is not enough, and just by being fanatic is not enough. You have to be a mixture of both. So you have to be intelligent to understand what works, and then you have to have that kind of a जिसको हिंदी में बोलते हैं जुनून. You got to be so much driven by that idea of making your business work. Then only you will get that kind of a result. So I'm giving you an example of a company. It is not a recommendation for investment. Please don't take that as a recommendation. But go and look at the history of Eicher Motors and look at how Rajiv Lal, the promoter, how he turned around the business in 2007, 8, 9, and what he did, and how the stock performed over the next 10 years or so after he transformed the company. You will get an idea of what an intelligent fanatic would look like. So this is another kind of a moat, which is probably the hardest moat, and which once being established, it is also probably the hardest moat to break. So एक बार आपके पास ये मोट आ गया, nobody can break you. That is the biggest advantage. So there are many examples of, not many, there are a few examples of intelligent fanatics also. Again, Google and YouTube would be the best source. We have covered some of them in our blogs as well, Smart Sync Services. You can check that out as well. Next slide, ma'am. So some thoughts on moats. I'll skip this one because we have already discussed. We'll discuss other points which are more important. So mistaken moats. Ma'am, can you just go back to the earlier slide again? So I just wanted to share some time on the game plan over here. So what do we need to do as an investor? So with game plan, it doesn't mean that investing is not exactly a game, but just like a game, if you have a plan, you would be much better. You will be in a much better position to gain out of it. So your process should be something like this, where you will identify businesses that generate above average profits for many years. Wait until the shares of those businesses trade for less than their intrinsic value and then buy. Hold them until business deteriorates, shares become overvalued, or you find a better investment. Holding period should be measured in years, not months. Repeat as necessary. So it's as simple as this, and it is very easy to say about it. I have been investing for over a decade now, and trust me, it is not something which is easy to follow. It's easy to read and speak about, but it's not easy to follow. And investing is 90% psychology and 10% knowledge. So whatever we are discussing today would only form 10% of our what works in investing. And the behavioral knowledge which you need in terms of investing, that can only come with experience. Investing is probably the only field where, however theoretical knowledge you take up through these sessions like this, you can't understand investing unless you start investing. So I would really recommend to people who are watching this class or attending this class, please start with a small amount and start investing your money. Until unless you see a stock going down 50%, 60% from your buying price, you will not be able to understand how it, then what does it mean, how much of your knowledge comes into play, and how you react, and try to understand and try to note it down. How you react when the market panics, how you react when the market is going up. Those are the subtle things which you will understand only when you invest. Yes, ma'am. So we'll move to the next slide now. So, mistaken and shallow moats. So there are some businesses which appear to be moats, but they are not actually moats. So as we briefly discussed about some of the companies or some of the products which you like having, but you still don't, you would not like to be an investor in those companies. So there are some examples like great products, several examples such as Crystal Crispy, Tommy Hilfiger. These are huge brands, but these are huge foreign brands where they have a big fan following. But when you look at their balance sheet, look at their numbers, you will find that they are not making profits. So if you take Indian example over here, there are many companies or many products in India where you probably use them a lot, but when you go to the balance sheet, check their accounts, you will see that they are not making money out of it. In fact, some of them are even in losses. So it is sometimes possible to make a great product, but it has to be a consistent stream of products being rolled out of the company. Until unless the company is able to do that, you cannot take that as a moat. Similarly, market share. In a hyper competitive market, many companies or many players would try to capture market share from the incumbents. But just capturing market share is not enough. You have to be profitable as well. And it should show in your balance sheet. It should show in your accounts. Similarly, great execution. Execution is an important part. Just strategy doesn't work. You have to execute. But just being great at executing things doesn't make you having a competitive advantage. Similarly, great management. There are many management which have shown a track record of being really exceptional in capital allocation, how they allocate capital. But that doesn't give you a guarantee that whichever business they go into, they will be able to make money out of it. I have a very good example over here. I don't know whether you have heard about this company or not, but if you are into investment, you must be knowing about this company. That is Piramal Enterprise. So Piramal Enterprise and Mr. Ajay Piramal, they have been, he's been known to all stock market investors over the last 10-15 years because of his strong track record, proven track record of making sustainable wealth over a long period of time by buying and exiting different kinds of businesses. So he started more into the pharmaceutical industry, but later on he also bought stakes in other companies and other industries. So because of his very good record in the pharma business, we were of the opinion, when I say we, the general market participants were of the opinion that they will do well in all the businesses they will be in. But if you look at their record in the financial businesses which they entered in 2015-16, so they are big time into real estate financing. And real estate in that period from 2013-14 till today is going through a lot of pain. So even though it was a great management, even though a management with a good track record, their performance in the business didn't do well because the business was not inherently having any moat characteristics. So we should be aware of this fact. Just because a great management is there doesn't make it easy for them to get into any business of their choice. Next slide, ma'am. Some of the eroding moats. So moat or competitive advantage is not a fixed thing. It is like Warren Buffett in many of his talks, he says that a company's competitive advantage cannot be fixed. It will either be strengthening or worsening over time. At any particular time, whatever company does, it will either strengthen its moat or worsen it. So as an investor, we should always keep a track whether what the company is doing today is going to strengthen their moat over time or weaken it. So that is very important. And just to give you an example of newspaper industry, if you look at newspaper industry, newspaper is something which we all read, not from today, but from long back. Even our forefathers used to read, and it's a daily habit of reading newspaper, right? But if you look at the last 10-15 years, the way we consume news has actually gone through a lot of change. Earlier, all of us used to read the physical newspaper, but I'm sure out of 25-27 people who are attending this session right now, I can bet that 90% of you don't read the physical newspaper anymore. You must be reading news through your mobile phone or your laptop, right? Am I right?
Yes, sir.
So this is a change which has happened. An industry which was making so much money and had so much such an attractive economics in the past now doesn't have so. So with this kind of an example, you should try to understand whether the moat is long lasting, durable or short lived. That is very important. Or whenever there is some change, you should be able to track those change and act accordingly. You can't just buy, and when I in my earlier slide when I said that you just buy those companies and hold it for as long as possible. As long as possible doesn't mean that you will forget about the company and forget about the business. The business keeps on changing and economic cycles are getting shorter and shorter. So you have to keep on track whether the company and the business is still on track, taking the right step to strengthen their moat. Because if you don't strengthen your moat on a daily basis, on a yearly basis, there will be a new competitor who will invariably come into the market and take away all the competitive advantage you have, right? So I'm just going through the slide a little faster because we have to cover a lot of things, but this presentation will be shared with you so that you can go through it in detail. Next slide. So what is the moat process? As an investor, how do you start identifying companies which have the characteristic of moat or a competitive advantage? So first question you should ask is, has the firm historically generated solid returns on capital? Solid returns on capital means ROE, return on equity. Okay. If no, the next question you should ask, is the firm's future likely to be different than past? So it might be a case where the business has not been able to generate solid returns in the past, but they are doing something different today, which can actually help them generate higher returns in the future. If the answer to that question is also no, that means that company doesn't have any competitive advantage. So as an investor, you should ideally just ignore that business. So having a process like this helps you in leaving out a lot of uninvestable companies. There are more than 5,000 companies listed on stock exchange. It is humanly impossible to go through all the businesses and check what they are doing. This is a very good checklist to just leave out. You can just put a, right now you can get, there is an online website which is by the name of www.screener.in, wherein you just have to write return on capital, return on equity more than 15%, say. You will get the list of all the companies that are having return on equity higher than 15%. So you should focus only on those companies. Just to begin with, you can start with those companies. You have to leave out the rest, right? Once you know this question, and then the next set of question would be, does the firm have one or more of the competitive advantages listed below? High switching costs, network economics, low cost production, any kind of intangible assets like we have discussed already. If it is not having any of that, that again says that there is no economic moat. So first filter is 15% से ज़्यादा ROE है कि नहीं है. If नहीं है, then there is no economic moat. The set of companies which are having 15% of having ROE in excess of 15% of having an ROE of more than 15%, then you have to ask those questions कि ये सब companies में competitive advantages है कि नहीं. Even though they are having an ROE of more than 15%, there might be a case where, which we have discussed earlier, these are mean reverting, wherein you are right now finding them in a cyclical upcycle where they might be prone to mean reverting and going low. So you should focus only on those companies which are having any kind of competitive advantage. Now the third set is, how strong is the competitive advantage? Is it likely to last a long time or a relatively short time? So a short time, an advantage which can last a short time is a narrow moat, and an advantage which can last a long time is wide moat. So what is a narrow moat? Narrow moat where, say for example, a pharmaceutical company introduces a drug which nobody has right now in place. So immediately you will find a lot of opportunity for that company to make profit. But those profit would be short-lived for 2-3 years, 5 years, because eventually those patent will run out and new players will be able to make the same kind of medicine. But if that same pharmaceutical company has a history of keep on rolling out those kind of drugs, then that pharmaceutical company has a wide moat, and you can take a long-term view on that. So we can, if we have any questions, we can take it up, or we'll move ahead.
Yeah, anybody has any questions related to moat, you may ask right now.
No problem, we'll move ahead.
Okay, sir.
Next slide, ma'am.
Yeah.
So, what is the most effective way to measure moats? ROE. We have already discussed about ROE at length, but now let me just spend a little time on the three levers of ROE. So, return on equity, as you all know, is net income by equity, or profit after tax by your total equity. Okay, but you should actually try to break it down to three levers. Number one is profit margin. Number two is asset turnover ratio. Number three is financial leverage. And by having a clear understanding of which lever is actually contributing to the ROE the most, you will have a lot of understanding about the business. So just to give you an example, there are FMCG companies or paint companies where they make huge margins of their product. So their ROE is influenced mostly by profit margin. Similarly, in case of companies where they are basically manufacturing companies making product for branded people or branded businesses, those companies will have thin margin, but they will have a higher asset turnover ratio. So for those companies, you have to look at the asset turnover. And then there will be some companies which will be able to drive their business based on other people's money or float. That's another chapter which you can maybe take a session sometime later if possible. So basically from ROE you should be able to understand which lever of ROE is influencing the final figure of ROE. And we have covered at length about ROE in a video. I have pasted the link of the video also. You can go through that at your leisure and understand about ROE in depth. We have covered every aspect of ROE in a very simple manner which you'll be able to understand. So you can probably go through that video, and if you have any doubts, you can even comment on the YouTube channel. So we'll be able to address that. Next slide, ma'am. Now we are moving towards the last session of portion of our session, which is economic moats. So management is generally not a moat, as we have already discussed. But management is very important to understand when you are figuring out or trying to understand an investment or trying to study an investment. So what does Warren Buffett says? Stick to proven management with a lot of integrity, talent, and passion. After some other mistakes, I learned to go into business only with people whom I like, trust, and admire. I would not like to take names of the companies over here, but there have been many examples in Indian economy where even though the business were really great, even though the industry dynamics were really advantageous, the management were not honest. The management didn't want to share the rewards of the business with the minority shareholders. So being an investor in those companies would not fetch you a good return on capital. Rather, your capital would have been wiped out. So as we discussed in case of Piramal, even though great management cannot guarantee you success in investment, but a bad management can actually guarantee your wealth being wiped out. So you should be very wary about the management of the businesses which you are studying. Next slide, ma'am, please. So if you follow brilliant management teams, it will lead you to brilliant investment ideas. It's pattern recognition. Just a very good example would be, I'm sure you would have heard about Elon Musk. Just look at the history of Elon Musk. He has been into different businesses right from scratch, and he has generated wealth for him and for his founders, co-founders, and for anyone who has invested in his companies. So that kind of pattern you will recognize in most good management. So try to recognize those patterns and try to be with those management rather than thinking about any random company. Next slide. So look for evidence in 4 basic areas. Whether the management is honest, really passionate about the business, transparent, and competent. See, the competence is very important. Even if you are honest, passionate, and transparent, if you don't lack the intelligence or tenacity or the competence to do really great business, you will not be able to generate wealth for your shareholders. So sometimes we do get enamored by the honesty and passion and transparency of some of the management, because those people are really good human beings. But that will not give you returns. Your returns will be a combination of all 4. So they must be competent also to run profitable business over time. Next slide. So while assessing management, you should ask some of these questions. How the company has performed under the management over a 10-year period, sales and profit growth. How has the balance sheet been over the year? How has management fared in the capital allocation decisions? So basically these 5 are the capital allocation decisions. Any businessman, whether a listed company or a small company business owner, you have to make these kind of capital allocation decision. Investment in capex and working capital, making acquisitions, buyback, paying dividends, and hold cash on the balance sheet. So if you look at any listed company, you just have to focus on these 5 parameters and see how the management has performed. Even inevitably, you will find great management would end up using the cash judiciously and allocating it into all these 5 areas in a very sensible manner. We should understand that managements are also humans like you and me. So they are bound to make some mistakes. Just because a management has done a mistake doesn't mean that they are a bad management. But if they keep on doing mistakes for say a 10-year period or 15-year period, you can simply avoid them, right? Then questions could be, how long has the current managers been managing the business? A very good example of a company and a company's culture would be their best employees or best managers are not leaving the business. They stay with the company, right? How are senior managers compensated? Next slide, ma'am. Next slide, yeah. So are senior manager continually increasing, decreasing their ownership interest in the business? Means are managers buying the stock of the company or selling the stock of the company? These kind of, and today it is very easily available. SEBI has made it a mandatory provision for companies to declare these kind of trades on the stock exchange. So you can go to the BSE filing and actually see on a daily basis wherein has any management sold or bought a stock. If a management is consistently buying the stock over a say 4-year period, 5-year period, that gives you confidence in the company that okay, they are walking the talk. They are actually buying more of the shares because they feel that their company or their business is attractive at this price. Similarly, look at the CEO and CFO, what kind of earning guidance they do. If you ask any company or any businessman privately, just do this thought experiment with your dad. If your family is into business, just ask your dad, do you know what your sales would be for this quarter or this year? Do you know what your profits would be for this quarter or this year? I am 100% sure that none of them would be able to give you accurate figures. Similarly, for listed companies as well, best managements are those which stay away from guidance. They will never give you a definite guidance. Management which offer you definite guidance, you should be very careful about those businesses. I'm not saying that those managements are not ethical or not honest. but they are not very sure. It's just that they are putting a number just because those questions have been asked by someone. It doesn't mean that the company will be able to meet that guidance. So does the management team focus on cutting unnecessary costs? So cutting costs cannot be a big bang operation. It should be in the DNA of the company, and you will find it through series of operations they keep on doing over a period of, say, a decade, where you'll see companies doing something or the other to just keep on improving their margins and reducing their costs. Look at the communication, how they communicate to the shareholders and analysts and investors. Look how independently they think, or are they just simply copying the competitors? Are they very clear and consistent in their communication? Just look at the communication of any company you are researching over the last 5 years or 10 years. You will be able to really make out whether the management has been clear and consistent or not. That will show in their interviews and their results. Is the CEO self-promoting? Again, there is nothing wrong with promoting your business. When I am coming here, I am also promoting my firm. You can see the SmartSync Services logo in the presentation. But there is a thin line between promoting and over-promoting. So if a management is promoting its business all the time, you should be a little more careful about that business and check a little more whether what they are saying is actually true or not. They don't want to fool you, or they don't want to fraud you, but it is in their own vested interest to show only the positives about their company. It is in their vested interest to hide the negatives. So then it is a better way of looking at a management, whether they are only showing the positives or also sharing the negatives. Again, a very good example which comes to my mind is Mr. Ajay Piramal again. Ajay Piramal, in a recent interview, he very clearly admitted and candidly said that in the financial services business, they became greedy at one point of time and bought in a lot of short-term borrowings to fund long-term assets of real estate. If you understand about real estate investing and providing loan to real estate, there is a concept called asset liability mismatch. So as a lending company, as a lending business, you should be able to match your timing of cash flows of assets and liabilities. So if you have long-term assets in the terms of real estate, you should match it with long-term liabilities like bank funds. But the company became greedy because a lot of attractive short-term funds were available to the company. So there is nothing wrong in doing that mistake. Obviously, what the mistake which they did cost us in their business, but the management was honest and prudent enough to admit that business and share that in their communication. That gives you a lot of understanding about the management, how they project themselves ahead. Next slide, ma'am. Some of the red flags which you can see in case of management. You don't want to see management paying itself exorbitant salaries and perks. You don't want to see promoters merging their private companies into the company whose stock you are evaluating. You don't want them to appoint their relatives who don't have adequate qualifications. You don't want them to have a lot of related party transactions with their own privately held companies. And you don't want to be involved in companies where the promoters trade in and out of the stock. A promoter's job is to do business. If the promoter of the business keeps on trading in their own company stock, that says a lot about the integrity of the promoter, right? And you don't want to get involved with promotional management. So we have covered all of them already. Let me just spend some time over here to point it out that this is not a fixed rule. So there are examples of companies and businesses where the management has been taking a higher salary, but they are still able to perform really well in their business. So don't spot these red flags as if कि अगर आपने company को study किया and you find that the promoter is taking high salary, you will just ignore the company. Don't look at it in that way. These are some of the red flags. Means you should be more careful about those companies when you study. Nothing wrong in taking a high salary as a promoter if you can consistently deliver in your performance. Let me put it in a different way. It is far better for you as an investor to find a promoter paying himself more and performing rather than a promoter who is hiding the books of account, hiding the cost, and not performing as per your expectation. So always try to look at the figure and ask yourself that question: can you trust the management? Can you trust the figures? So those things will help you become a better investor. So if I can just share a couple of minutes, spend a couple of minutes in your journey as an investor. So you have already got a lot of technical knowledge of fundamental analysis from Pratibha ma'am in your class, right? Then you have got a little bit of practical flavor in this presentation. Now, if you really are excited about investing in stock market, you should have a journal, your own journal or your own diary, where you should note. Start with small amount and see how you are reacting to the news, how you are reacting to the performance of the company, how you are reacting to the volatility of the stock prices, and check. Even though after knowing everything, which are the times where you forget all those things and act either in greed or in panic. That will make you a better investor over a period of time. I think we have just come to the end of the presentation. Next slide, ma'am. So conclusion. So with this presentation, we have got a brief understanding of how industry is paramount. Some industries are worth investing in. Some industries are better left not investing. So any kind of commodity industry where you don't understand the cycle, it is better to ignore that industry. You don't have to buy all the companies or all the industries. You just have to know a few and know them really well. Second, economic moats, we have already covered that. Economic moats help us find excellent businesses. You should focus only on those businesses. Your odds of making money goes up when you invest only in excellent businesses. Understanding management is a key element of research. One point which I have consciously avoided, which we have not covered in this presentation, is valuation. So after industry, after business, after management, the fourth thing which needs to be understood is valuation. But valuation is something which comes at the end, not at the beginning. So we can separately have a course on, have a session on valuation if time permits sometime later. So that's pretty much about the whole session of moats and investing from the lens of economic moats. I hope you could find some value out of it, and if you have any questions, please ask now, or you can maybe write it down to my email ID. I'll be able to address them. You can also follow us on Twitter and YouTube if you would like to.
Okay. Yeah, everybody, do you have any questions to ask? You may please ask. Or else what we do is we take 10 minutes break now, right? And we will join again for the second part of this session, right? So 10 minutes break for all, and we'll be back at 1:35 now.
Okay. Thank you, ma'am.
Yeah.